Hello everyone, this is the second in my series about financial planning and the stock market. You should peruse the first video called Investing 101 before getting on with this one. If you haven't, by way of brief introduction, my name is Brian Forrest. I'm a certified financial planner with a financial services firm here in Toronto, Ontario. I traded my first stock when the Dow was at 700, and today the Dow closed at about 12,515, setting a new all-time high during the day. Now, this particular segment is aimed at those of you who have had at least some experience with stocks. And to begin, it would be helpful if you did a little reading on the subject. And if you are relatively young, say in your 20s or your late teens, pick up a copy of The Wealthy Barber. This book is not really a primer on investment technique, but after you read it, you at least will understand what a huge advantage it is for you to start this whole process when you are young. Because if you do begin now, you will inevitably be wealthy when you are my age, and possibly a lot sooner. And speaking of wealth, remember this: you don't accumulate wealth by working, you accumulate wealth by investing. Now, for those of you who want to tackle the subject seriously, the best book on investing ever written was by a guy named Benjamin Graham, and it's called The Intelligent Investor. It was first published in 1949, and with revisions appearing every 5 years or so until 1973, and Ben died in 1976. Now, the basic precepts for successful investing that Graham laid out have never changed, and in fact they're even more relevant today. So let's start with a quote from the great man that defines what an investment is. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Now, Graham wrote an entire book basically explaining those two sentences, so it's going to be a bit difficult for me to do the same in the next 10 minutes. But why don't we start with one piece at a time? To begin, what does he mean by thorough analysis? Well, Ben was a security analyst, and in his day he was accused of investing any prospective investment down to its molecular level. You can't do that, but you can get access to the research done on any company by a chartered financial analyst. You can read various reports on the company freely available on the internet, and you can call your broker for an opinion and further information. The point is, be informed. If you don't understand what a company does or why it's successful at doing it, you have not done enough research. You have not done your thorough analysis, your due diligence. Now, the next phrase that pops up is safety of principal. Now, this means you don't want to lose money. Losing money pisses me off. You should try to avoid it. But the world is fraught with risk, and the very act of investing your money opens up the possibility of loss. You want to limit any possible loss. Why? Because losing a lot of money is far, far easier than making it. Remember this simple mathematical truism: take $100 and lose 50%. With your remaining $50, you have to make 100% to get even. The investment landscape is awash in the tears of speculators who will never recover their hard-earned dough. Don't be one of them. So, how can we avoid steep losses? Well, Graham comes from the school of thought called deep value investing. He advises buying the stock in companies at close to or even below net tangible value. And now, in this day and age, it's sometimes quite difficult to determine exactly what net tangible value means. But in simple terms, say we're buying a real estate company whose business it is to own and rent out apartments. Their assets consist mainly of their real estate holdings. Add up the value of those tangible assets, things that you can hold in your hands, deduct any debt and divide by the amount of shares outstanding, and that is what you want to pay for your shares. Thus, if the market ever goes sour on you, at least you know your shares do have intrinsic value. Now, the basic question you want to ask yourself before purchasing a stock is the same question you ask before buying anything. How much? Would you pay $5,000 for a cell phone if everyone was yelling, "Look, cell phones are going up in value, grab one now. You'll be able to sell it next week for $6,000. Well, this in essence is what millions of people do every day when they buy the latest hot stock. Buying a hot stock is not investing, it is playing the market. And it is possible to make money playing the market, but no one has ever done it consistently year in, year out, and eventually speculators will get badly burned. Now, to get a handle on Graham's investing approach, you can think of it as a ladder. If you're on the first rung or two and you fall off, you're not going to do too much damage. But if you fall from the roof level, you can seriously hurt yourself. So buy stocks when they're cheap. And if you can't figure out what cheap means when it comes to stocks, call your broker and ask him. Okay, another piece of advice that Graham offers to preserve principal is to make sure you own a good percentage of high-quality bonds. Now, as a general rule, high-quality bond, if held to maturity, offers much less risk than a stock in the same company. So if you divide your money between stocks and bonds, you are automatically lowering your overall risk. It's a good thing. In today's low interest rate environment, I am constantly hearing from various investment pundits scoffing about how useless a 5% bond is. That is until they lose 20% on their stock portfolio, then making 5% doesn't seem like such a bad idea. Even the most intelligent professional in this business will at times forget the basic tenets of investing. That with all reward comes risk. And if you only focus on the possibility of gain, therein lies disaster. Look for gains, but adjust for risk. Bonds adjust your risk. Own them. The next phrase we see in Graham's missive is adequate return. What does that mean? I can tell you what it doesn't mean. It doesn't mean that you should expect to double your money every 6 months. On the other hand, we certainly don't want to invest the time and the money and assume the associated risk of the stock market if in the end we get the same return as offered on guaranteed certificates of deposit at your local bank. Graham delineates a formula based on the long history of the stock market, what the current average dividend yield is, what bonds are paying to arrive at a definition of adequate return. But without offering a long discourse, let's just say that currently an adequate return represents a yield, an annual yield of between 9 and 11%. Now, if you can keep your expectations at this level, you'll be a happy camper. There is an old saying on Wall Street, bulls make money, bears make money, and pigs get slaughtered. Control your greed impulse. And remember that a true investment should be looked at in a time frame of about 5 years, and that the investment process itself is a lifelong endeavor. It's like brushing your teeth. You have to do it your entire life for it to do you any good. For you young people out there, if you can learn to save a few bucks each year and keep adding to your portfolio, an 11% annual returns means you will be a millionaire by the time you reach my age in the 50s. Now, maybe you'll do something else that'll make you fabulously wealthy before that time. But as Trump says, always have a plan B. Okay, on to the final sentence in Graham's missive. Operations not meeting this requirement are speculative. Human beings are possessed with an impulse to gamble. This urge is impossible to eradicate completely, but it can and should be suppressed. Along with stories about how much people lost on the stock market, I'm sure you've heard various spectacular success stories as well. My fellow brokers are loath to talk about their bad choices, but are always willing to point out their best picks. We have clients who have made hundreds of thousands of dollars on junior mining stocks, for instance, in the last few years, and thus they are now only willing to buy junior mining stocks. And of course the tide is now changing on the world commodity market, and in particular the Canadian resource sector. So these portfolios have begun to lose money. There's nothing in them to mitigate the risk from being exposed to only one area. And if you have studied and experienced the long history of the stock market over the years, or for that matter any market, the gold market, the real estate market, whatever, you will come to the absolute certainty of this one thing. All bull markets end, and most of them end badly. So if you must give in to your primordial urge to play the market, by all means go ahead, but don't gamble money that you can't afford to lose. And don't delude yourself into believing that playing the market or gambling on a junior gold stock is investing. It's speculating. So keep this activity separate from your main accounts and allot about 5% of your portfolio's value to speculating on hot mining stocks, junior oil plays, or unproven tech stocks. Maybe you'll have some fun, or maybe you'll make some money. But at least you'll know that you can't lose more than 5% of your total holdings. Alright, so till the next time everybody, prosperity to all.